Attendees are in listen-only mode.
Hi everyone, welcome to today's Wednesday webinar hosted by EPIP. We're excited to be together with Hannah Schiff from the Global Impact Investing Network and Tracy Carty from the Annie Casey Foundation to talk to you today about catalytic capital using guarantees to unlock private capital for impact. This conversation is part of our Wednesday webinar series, which is one of the home EPIP programs. And if this is your first time here with EPIP, we wanted to welcome you and give you a little bit of background on who we are and some housekeeping before we move into the presentation. EPIP stands for Emerging Practitioners in Philanthropy, and we are a national network of foundation professionals, social entrepreneurs, and other change makers who are striving for excellence in the practice of philanthropy. Our mission is to empower emerging leaders and elevate philanthropic practice in order to build a more just, equitable, and sustainable society. We do this work by providing a platform for our community to connect with each other through our 16 local chapters and our national programs, as well as learn and practice leadership skills and develop new skills, and to give space to inspire new ideas and also witness and lift up the leadership of folks throughout the philanthropic sector and those who want to help improve philanthropic practice from outside of the sector. If you have any questions or if you'd like to learn more about our programs or membership, please feel free to reach out. My name is Biz Gormley, and I'm the Director of Operations and Member Services. My email is on the screen right now, and you are welcome to email me here directly or reach out to us through the website, and we'll do our best to answer any questions you have. I wanted to spotlight a few things that are coming up. The first is that we have a webinar on August 16th at 3 p.m. It's focused on countering systems of hate. It's going to be a conversation with philanthropists, activists, and some other folks that are working together, especially in light of the political climate and targets on specific communities, to think about how philanthropy can play a role in countering the forces of hate in our current environment. You can register for that, local chapter events, and a variety of other upcoming events at epip.org/events, as is listed on the screen. And finally, if you are able to join us, we would love to have you at the Unity Summit, which is the conference for EPIP's community this year. We're joining together with our partners at Change Philanthropy, and you can register at the URL that's on the screen, changeunitysummit.org. It's in September in New Orleans, and we're happy to answer whatever questions we can and hope that you can register to join and be with us live and in person in New Orleans. Some quick housekeeping. You'll see in your control panel a space for questions. Please go ahead and use that both as a way to share if you're having technical difficulties so we can help you troubleshoot them, and or put in any comments or questions that you have for the conversation. And at the end of the talk, we will have a Q&A portion where we will ask our speakers to answer your questions there. So if you have things that come up throughout the call, feel free to type them in. The questions are anonymous. We're also going to do a poll in a moment, which is going to be anonymous. And if you are following us on social media, if you can use the hashtag EPIPwebinar in your tweets or Facebook posts or wherever you may be posting, that helps us track the conversation, and we appreciate it. Also, we are recording the webinar so that it can be archived on our site and used for you, by you and others as a resource going forward. And then finally, at the end of the conversation today, you will see a screen pop up that has a few questions. I think it's about 7 questions. It should only take a moment, but we'd love to hear your feedback on today's conversation and ideas or topics that you'd like to see more of going forward. Today's talk is part of a series we've been able to have with wonderful co-hosts on topics related to impact investing. And if you were able to join our past impact investing webinars, wonderful. And if not, we're happy to help you get in touch with those resources as well. So if you aren't able to find them, just email us and we'll help you connect to those past webinars. So now I'd like to move, I'd like to move into a poll. that will allow us to get a sense of who's on the call and how your experience relates to the topic we'll be discussing today. So if you could please take a moment to reflect on your current employer or your current institution's work regarding mission-related investments or MRIs. If you can please check the answer that best corresponds to the status of impact investing and mission-related investing, etc. at your institution, we appreciate it. I'm going to leave this up for a few more seconds, and then hopefully we'll get responses from all of you guys on the line. All right, 5 more seconds. So if you are able to respond if you haven't yet, we appreciate it. Great. So you should be able to see on your screen the results from our quick poll. It looks like many of you either are already involved in investing with your institution, either in a large commitment, some initial pilots, or you're in exploration phase. It looks like the majority of folks are actually in that exploration phase, and we're excited to have you here to help hopefully with your process. So without further ado, I'm excited to introduce both of our speakers. Hannah Schiff is from the Global Impact Investor Network, and investing, excuse me, a typo on the screen, where she plays a central role in research and will tell us more about explicitly what she does. But we're excited to have her here as a representative of Jen. And Tracy, who's here from the NE Casey Foundation, is the Director of Social Investments there, and will be giving us some specific examples from the work she's been doing on this topic there. So welcome to both of our speakers. Thank you for your time and your expertise. And I'm going to turn it over to you, Hannah.
Great. Thanks so much, Biz, for this opportunity. And hello to everyone on the line. Thanks for joining us. It's great to see that so many of you are at least exploring and considering impact investments. I'm going to start on the next slide with an intro to the GIN. For those of you who aren't familiar with us yet, just briefly, we're a nonprofit based in New York City, and our mission is to increase the scale and the effectiveness of impact investing worldwide. We do this by building various types of infrastructure and helping to convene market players. We have a global membership with more than 250 member organizations in more than 30 countries. On the next slide, I have our definition of impact investments, which we define as investments made with the intention to generate both a positive social or environmental impact and a financial return. There are some core characteristics that kind of underpin this definition. So again, the intentionality to generate positive impact, seeking a positive financial return, and then the fact that it can be made across asset classes and with different return expectations. So from below market rate, concessionary kinds of capital up to market rate return expectations as well. And then lastly, that impact measurement is a hallmark of this practice. On the next slide are the logos of many of our member organizations, and I just wanted to point out the diversity of this impact investing market. This is obviously not all of our members or all impact investors, but it gives you a good flavor for the different types of players active, foundations, banks, pension funds, fund managers, and others. And there's a great need within the space, which is also an opportunity for these different types of investors to collaborate and amplify their impact. And credit enhancement, this kind of broader topic that guarantees fits into, is one of the ways that investors do collaborate to increase the flow of private sector dollars into impactful investments. So if you'll move to the next slide, credit enhancement in general has been a focus topic for the GIN over the years, and we've done previous research on a different form of credit enhancement called first loss capital. Back in 2013, we published the report you see on the left, but we hadn't yet explored guarantees in depth, and we shared a hypothesis with the Kresge Foundation that guarantees had a lot of potential as a tool to move capital into impact investments, but that it was currently being underutilized in impact investing. So we were excited to partner with the Kresge Foundation on this project. The project included 2 tracks. There was a working group of GIN members and also a research project, and they resulted together in the report you see on the right. And so to develop that report, we conducted 40 interviews with practitioners. We compiled and analyzed a database of 58 guarantee-backed deals in the U.S. community investing space. And we worked with the working group to also refine those findings. And in a moment, I'm going to present some of the kind of highlights from this report. But before doing that, I just wanted to actually give a really, really simple example of a guarantee to make sure that we're all on the same page about what it is. I'm sure most of you on the line already know, but on the next slide, let's say a housing developer needs financing to build a new affordable housing project that has added services for residents there. It's going to be really great for the community, but the bank kind of wonders, is this a good credit risk? Is the return that I'll get enough to justify the risk that I perceive or that I may not even be able to really assess, given the fact that it's in a distressed area, and maybe this is an inexperienced housing developer, or maybe I just don't really know that much about their business model or how to assess, lending to nonprofits. And so the bank kind of has a question mark. I'm not so sure if I should make this loan. On the next slide, a foundation or another entity can basically stand behind the developer and promise to pay some portion of the bank's potential losses in case of some kind of event in which the housing developer defaults on part or all of the loan or can't pay. And so, another really simple example is if you've ever gotten a guarantee to sign a lease for an apartment, you really know the value that this can provide. Then on the next slide, let's talk about how they can be used in community development, investing, and why. So as I mentioned, they're a form of credit enhancement, which means that they can address risks that would prevent otherwise really interesting and impactful investments from being financed. So for example, some types of risk that they can effectively address include borrower credit issues, kind of like the one that I discussed before, like maybe this is a new organization or just doesn't have that much track record or collateral that's appropriate. Construction risks associated with certain geographic markets, and then also the risks that are involved with new and untested business models, which we encounter a fair amount in the impact investing and kind of social enterprise space because we're trying to innovate to solve tough problems. As the second bullet refers to, sometimes there are investors or lenders who just actually don't know enough about this business model or this type of investment to assess the risk with confidence. So a guarantee can help them just gain that experience to be able to underwrite the risk themselves and really be confident in their understanding of it. Guarantees can also improve the terms of a deal. So for example, they can facilitate longer time horizons for repayment, lower interest rates, or higher loan-to-value ratios. And each of these bullets kind of represents a way that foundations can leverage limited dollars and also not necessarily require current liquidity or upfront payments to facilitate access to finance for projects that can improve communities and the lives of the individuals living within them. And so on the next slide, I wanted to share a bit about the types of projects in which guarantees have been used according to our research. Clearly, the sector where they've been used the most is affordable housing, as you see in the bar on the left. 19 of the deals in our database were in that sector. And this makes sense because a lot of community investment in general falls into this sector. The second bar shows that many guarantees have helped finance investments with broader economic development or community revitalization roles or goals, such as job creation for particular populations. The third bar refers to other types of community real estate, like child care centers or community centers, fire stations. And then the sort of long tail of this graph shows that, well, guarantees have been used to some extent in a wide range of sectors, sort of not that much in each of those sectors. So we think this points to the idea that there's a lot of opportunity for greater use of this tool in other sectors like education, health, energy, access to healthy food, etc. So on the next slide, we wanted to test the hypothesis that we had with the Kresge Foundation about limited uptake and scale of this tool of guarantees in impact investing in the US. And we found that about 80% of the guarantees we looked at were under $5 million, and about 80% of the projects or funds that they backed were under $50 million, so relatively small. And then another feature related to scale is what the guarantee applies to. So guarantees could be negotiated for a specific single loan, or for a fund that makes various loans or investments, or they can be set up as a program, so a sort of long-standing program that has basic criteria, and any project or enterprise can apply to it, and if they meet those criteria, they'll be eligible for the guarantee. So you might have heard of, for example, the Small Business Administration Loan Guarantee Program, which is one of those. And this can be really good for scale, because you just need to figure out that those criteria and that process once and make it really clear, and there's little question as to what fits in, and it can be used over and over again. But this type of program is, as we found, actually not so common. So most of the guarantees that we looked at were negotiated for a specific loan or maybe a particular fund. And this kind of case-by-case or one-off way of negotiating means that there's a lot of customization that can happen based on the needs of a specific deal and the specific set of stakeholders involved. This is good on the one hand because it means that this is a flexible tool. It can be tailored to achieve the type of impact you want to see. But it also means that guarantees are often quite time and resource intensive to structure. This leads to kind of our next finding on slide 11, which is that guarantees do tend to be quite customized in terms of their structures and features. And as you can see in this chart, there's a wide range of coverage levels. And what I mean by that is just the percentage of potential losses that will be paid out from under 10% to all the way up to 100%. And the colors on the graph here show whether the guarantee is fully funded, partially funded, or unfunded. And what that means is whether there's capital that's set aside either in some kind of bank account or as a loan loss reserve, or at least reserved on the institution's own balance sheet, and sort of set aside, whereas an unfunded guarantee is essentially just a contract promising to pay, and it requires no outlay of capital, which providers of guarantees find a benefit in the sense that that capital can sort of remain invested as it would be in the endowment or the corpus, and earning the financial returns of the rest of the investment, of the usual investment portfolio, while kind of also doing double duty by backing up whichever transaction it is for. Of course, the risk needs to be managed because a guarantee could potentially be called, but in the meantime, if there's not a high risk of being called, then it's earning a return while unlocking some amount of capital. And the guarantees we looked at also had a lot of variation in terms of what the conditions would be that would trigger a payout, and also the process in that event. We found that mattered a lot to lenders and investors that are gaining protection from these guarantees, because they want to know how easy or hard it's going to be to recoup their money in case they need to call on the guarantee. So the report has some guidance and resources for understanding these structuring options, and it also has 4 in-depth case studies that demonstrate how this variety of structures can be used. What I'm going to do now is just give a brief overview of 2 of the 4 case studies, just to add some color to the data that I've shown, and then I'll hand it over to Tracy. So the first example on the next slide is Healthy Neighborhoods, and this is one that Tracy and her foundation were eventually involved in. Healthy Neighborhoods is a nonprofit organization that helps revitalize Baltimore neighborhoods by improving properties and also strengthening neighborhood identity and cohesion. And in 2006, they raised a $40 million loan pool from 10 lenders to lend to homeowners at slightly below market interest rates. And the loans were mostly used to purchase, refinance, and renovate homes. So in the initial pool, a guarantee from 3 foundations plus the Maryland Housing Fund covered up to the first 10% of potential losses on each loan. This enabled a loan-to-value ratio of 120% of the post-renovation appraised value, which was more than it would have been without this guarantee. It did this by mitigating the risks associated with this depressed local housing market, borrowers with limited collateral and credit history. The startup of this new lending program by this nonprofit kind of hadn't done exactly this before. The success of this first loan pool led to the raising of a second loan pool of a similar size. And in total, the two pools originated 352 loans totaling $53.6 million, with defaults costing only 2.5% of capital. And these types of loans are, this is all the technical and the numbers, but I think it's really apparent that they can make the difference between a neighborhood that's sort of in decline and perhaps disrepair, and one that becomes a healthy and safe and vibrant place for families to live. So the next example on the next slide is involving two community development finance institutions, or CDFIs, that saw an opportunity to lend into a sector that was new to them. Federally qualified healthcare centers, or FQHCs, and these are community healthcare centers in medically underserved areas. And this idea was appealing to the Kresge Foundation, which ultimately provided the guarantee, because it fit two of their goals, one of which was improving healthcare in low-income communities, and the other was supporting collaboration between CDFIs. So the foundation initially funded research to identify the states with the greatest need for FQHC financing. And the areas that ended up being identified were new geographies for these two CDFIs. So now, in addition to going into a new sector for them, they were also going into new geographies. So the Kresge Foundation provided a $5 million guarantee to mitigate these risks and enable the CDFIs to more easily obtain board approval for these loans, which would be coming initially out of their own balance sheets. 2 years later, the program had deployed $15 million into 3 centers, and all of the loans were performing well. So the CDFIs were actually able to raise additional capital from a major bank and another foundation, backed by the same $5 million guarantee. So that means that the Kresge guarantee was leveraging even more capital and enabling the CDFIs to prove that they could successfully lend into this market segment. Eventually, down the line, they'll be able to do so without any kind of credit enhancement. So I really like this example because it demonstrates the kind of catalytic effect that this type of capital can have. It unlocked the flow of financing to make affordable healthcare accessible in medically underserved areas. So like I mentioned, there's 2 other case studies in the report and more detail on these, and there are also recommendations and resources for streamlining guarantee structuring. But for now, let me stop there and turn it back over to Biz or to Tracy, I suppose.
Thanks, Hannah. This is Tracy. It's a pleasure to be with you all this afternoon to talk, to maybe put a little more color to the report that Hannah just went through, and really illustrate how the KC Foundation uses guarantees in our own investment practice. I wanted to start just to provide a brief overview of KC and our approach to impact investing so that you could have a little context for where the guarantees fit in the organization. So you can go to the next slide. If you're not familiar, the KC Foundation was established in 1948 by Jim Casey, who was the founder of UPS. So Annie E. was his mother. The mission of the foundation is to build brighter futures for all children in the U.S. And we do this through, we work towards this mission through a range of strategies, some of which are place-based and focused on what you might think of as traditional community development activities that range all the way to engaging directly with child welfare and juvenile justice systems. And so we see social investments, what we call social investments, other foundations refer to as impact investments, is one tool that we have to help advance our mission work. So we really see it as a complement to grant making. Our investments are actually managed as an allocation of our endowment. So the investments that we make go beyond our grant payout. But they're very much a complement to what we're doing on the grant making side. And we have a lot of flexibility to ensure that there is that alignment with our grant strategies. So we can do place-based investments as well as what we call thematic investment. So place-based investment might be something that relates to affordable housing development, and a thematic investment might be something that is about how do you create quality jobs in a range of investment structures, from small business lending to private equity investing, for example. On the next slide, you can see this is really a little bit of a busy chart, but really what I wanted to show was that the private foundations have capital that on the right hand, we think about our endowment that is invested in a way to maximize financial return, which in turn allows the foundation to make the grants, which are on the other side of the spectrum. Impact investing is, closer to the grant side in that you're trying to achieve a targeted social return. So there's some sort of positive impact that you're seeking to affect through that investment. But they're dramatically different from grants in that you expect to be repaid. A program-related investment actually has an IRS definition that requires it to meet certain criteria. But one of the hallmarks is that it's an investment that is made for the charitable purpose and not for the financial return. So oftentimes that means that you're getting a below market rate financial return, whereas MRIs or mission-related investments still get that positive impact, but also get a market rate financial return. And there's a lot of flexibility, as you can see on the slide, on the following slide, where there's a continuum that was generated years ago by the Harem Foundation that really shows that you can make investments across all different asset classes. And where guarantees fit are right in the middle. So with a guarantee, you don't have to necessarily pay out capital, but you might. There's usually some sort of a guarantee fee that is charged, so you get some sort of a nominal financial return on it. But as you move away from the center, you're actually investing in riskier asset classes. And on the right side of the spectrum, that means that if you're in private equity, you're expecting a really high financial return as compensation for that risk. Whereas on the left hand, you can do program-related investments in equity or other types of debt products, but you don't necessarily get a market rate compensation for that risk. So, but I thought this was an effective slide to share just so that you could see where guarantees fit and how they're very much an asset class, just as a loan to a community development financial institution is, for example. If you go to the next slide, I'll talk a little bit about Casey's portfolio before moving into some examples of guarantees. And this slide is, I think, reflective of one of the slides that Hannah showed, in that most of our investments are allocated in housing and community development related activities. As you can see, we have almost $6 million committed to social investments across a number of different program areas. Housing and community development, given our place-based work, has been kind of a natural fit for this type of investment tool, given the real estate development that often goes hand in hand with community revitalization. We also have a strong set of investments in what we call economic development, and those are really investing in a range of different entities like CDFIs, but also funds that are seeking to create quality jobs for low-skilled workers or residents who live in low-income communities. And we invest across all different asset classes and have had a tremendous track record in investing in ways that leverage additional capital for our mission. So of the $161 million in investments that we've made over the past 15 years, we've leveraged almost $1.5 billion for that work. And that's not including the guarantees. So for Casey, we will leverage our balance sheet. Most of the guarantees, in fact, all of the guarantees that we've ever made have been unfunded guarantees, as Hannah mentioned. That has allowed us to keep money invested in the endowment, earning a risk-adjusted market rate financial return, and still getting that targeted social impact that we're seeking. So we feel like guarantees are a really useful and effective tool for us in the right set of circumstances. So I can move into a couple of examples on the next slide. I wanted to share I mean, guarantees can be applicable in a number of different situations. So, for example, the first guarantee that the foundation did was related to work that we have supported in East Baltimore. There were a series of new markets tax credits that were kind of one of the early steps in financing a really large community revitalization project in the East Baltimore neighborhood. There was an organization, East Baltimore Development, that was created to manage and oversee the redevelopment process that actually required relocation of hundreds of residents out of the neighborhood. And these tax credit transactions were a way to finance some of that initial work that had to happen in the community. But, you know, it was a speculative project. It was new partners. It was a new entity managing the transaction. So there was a lot of risk in there. The foundation was really committed to seeing the residents being treated in a way that we wanted to ensure that they were in a better off position and not put in a worse position than they were living in as a result of the relocation or the work in East Baltimore. And so we were committing grant money. We had our program staff were deeply involved in the work. And that gave us a lot of confidence in our ability to see these tax credit projects through to completion. And we felt comfortable providing guarantees. And in this case, these were 100% guarantees given the speculative nature that the investors were really concerned about. But going through these time-intensive, complex, and expensive transactions it became important for this work because they generated equity, and here this is equity like grant capital equity. It didn't need to be repaid, of $13 million. So that was really central to the ability of the work to move forward. And you know, today the transformation is just really amazing. You can see the $35 million in new infrastructure development. The resident relocation was deemed very successful. There's new office and housing construction. There's actually a new park that just opened recently with a brand new playground for the community. So you're beginning to see all of these amenities come online, which is very encouraging. And at this point, all of our exposure for that guarantee has rolled off. So we are not, so those guarantees were never called. We can move to the next example, which is the Center for Family Representation. This is a guarantee for a social enterprise that needed a bridge loan for a period of time when they were renegotiating their government contracts. So the Center for Family Representation provides legal services to families with the objective of keeping them together during times of crisis. So they coordinate not only the legal assistance, but there is also a social work coordination aspect as well. We provided a 90% guarantee of a $750,000 loan. You know, the guarantee was necessary because, you know, even though they had verbal assurances from the government agencies that the contract was going to be executed and it was going to be executed at a specific rate that was going to cover all of their costs, that was still verbal, and you still had to go through the government approval process, which, you know, anything could happen. But we were willing to take that risk and had structured the guarantee so that as the line was paid down over time and they demonstrated their ability to manage payments during this period, that the foundation's exposure through that guarantee would also be reduced. And ultimately, that they were successful in renegotiating their contracts. They did repay the loan. During that time, they served more than 2,000 clients with representing 4,500 children, 50% of whom were avoided foster care. And then those that couldn't avoid foster care, their stays ended up being much shorter than average. So that was, so those are all outcomes that are important, and one of the reasons why we felt the Center for Family Representation, it was really important to support them in this time of transition as they were renegotiating their government contracts. So those are just some examples of how we've engaged in guarantees, and I think they illustrate what my next points will be around, as you can see on the next slide, around how we approach them. You know, as a mission-first investor, meaning, we're not making investments unless we can make some connection to the foundation's grant-making strategies and therefore our mission. We really want to make sure that the investment is structured in a way that facilitates both that impact target and the financial return objective. So if there is a way to really efficiently utilize the foundation's resources through a guarantee, then we want to do that. But obviously, we want to make sure that that's the right structure, as opposed to ultimately, if we're providing a guarantee, and it's an example like the Center for Family Representation, where you want to see the organization demonstrating credit-worthiness. That's a more effective way in the long term for the Center for Family Representation to gain access to capital than the foundation providing a loan to them directly. In some cases, it really is about, can the guarantee leverage a substantial amount of capital? And that's what we were looking at with Healthy Neighborhoods. We actually structured $1 million guarantee for the second pool, but we provided a $25,000 first loss grant. In some ways, that was more about KC managing its internal accounting, because it's easier when you pay out on a grant. When you pay out on a guarantee, it counts as a charitable distribution. And so we felt like there would be losses with this guarantee, and we just wanted to make it easy to facilitate payment on that guarantee. And we thought our real loss exposure was around $25,000. A $25,000 grant was not going to leverage or help to leverage $40 million of a loan pool. But the $1 million guarantee was a much more effective tool to do that. So that leverage piece was really important, particularly when you're looking at pooled assets that you're trying to raise. And then I would say, sorry, I think I actually covered all the points that I was thinking of covering here, but I would just also make a comment or re-emphasize one of the reasons why the foundation really likes to make guarantees when it's appropriate is because we are able to maintain those assets in our endowment as a way to continue to generate a market rate return, and at the same time get that impact. So we find it a really useful tool, but like with all impact investments, you have to have the right situation. In terms of what we've learned over the past 15 years, you can see on the next slide that it's really important when you're entering in or considering a guarantee that every person who is at the table is on the same page, that you really have a way to communicate and talk about why you're there, what you hope to gain for it, what your boundaries are. So what can you and can't you do? I think particularly when you're providing a guarantee to a regulated financial institution, understanding, how much risk can they reasonably take on, and finding that balance between what it is appropriate for the foundation to guarantee can be tricky. But if you're not having those conversations, it could be really painful later on. And just to give you an example of that, we did a guarantee for a working line of capital for a social enterprise. The bank thought that they were doing the foundation a favor, and the foundation thought that they were helping this organization demonstrate creditworthiness, and that the bank would, kind of relax as they demonstrated a strong track record. And when we realized, a year into it, that we weren't actually on the same page, it made for a very tense set of circumstances. And ultimately, what happened was that that bank was refinanced out of the deal, and they were able to find financing with the same guarantee terms with another bank. But all of that could have been avoided if we had been on the same page from the get-go. I think also really understanding in your organization where just because you're providing a guarantee and it's unfunded and the capital isn't going out the door, that doesn't mean that you shouldn't be underwriting what the transaction is, and really understanding the likelihood of risk and financial loss. I think we, as a foundation, often have a unique perspective on what the risk is in a community, and have a lot more flexibility than particularly regulated financial institutions. But you don't want to go into any transaction expecting that there's going to be a call on the guarantee, or that all of your guarantee is going to be called. And certainly you also have to really be clear about how much of a loss tolerance are you going to have. I think in instances where there's a call on the guarantee, and actually in every case, we have always structured our guarantees so that we can recover that capital after it's been paid out. So for example, if there are assets to be recovered or perhaps it transfers to a direct loan to the entity that they can pay out over time. But we don't necessarily want to be put into a position of being the entity that might foreclose on, an affordable housing complex or a charter school or something that is providing value in the community. So we want to be very clear about that circumstance as to how far are we going to go, particularly because recovering those payouts can be really time-consuming and expensive. So really understanding, like, if there's going to be a loss, what's your tolerance for losses? What are you going to do in terms of trying to recover capital if that's possible? So those are all really important considerations to really think through before entering into a guarantee. And really, so I think at this point, I can turn it back to Biz. I don't know if there are any questions. I'm happy to talk, to provide some other examples or talk more about how we think about guarantees.
Great, thank you. Yeah, there's a bunch of questions. I'm going to pause the showing of the screen so that we can focus on the questions themselves. And if folks haven't yet typed your questions into the question box, please go ahead and do so now. The couple questions came in at the beginning that may have already been addressed in some part by the subsequent slides, but I'm going to ask them anyway in case. And the first is, how do guarantees fit into the broader concept of quote unquote blended finance? Would either of you like to pick that up?
This is Hannah. Maybe I can start, and Tracy, if you have something to add. Blended finance is a topic that the GIN is very interested in and has taken on, and will continue to do more work on. So I think we think of it as basically just different types of capital coming together within the same deal, and so we would probably consider guarantees a type of blended finance. There are other types like first loss capital that I mentioned. The difference between first loss capital and a guarantee is that in first loss capital transactions, the capital is actually part of the deal and can be lent out or invested directly, but just is there to absorb whatever the first losses are. So it's a little bit of a different tool. And then there may also just be other examples of different types of blended finance structures. So I would say, guarantees are one type among many. Anything to add, Tracy?
No, I think that's right. And we'll often see, funds or fund structures where you have bits and pieces of all these different types of capital with some first loss, with some guarantee, with some subordinated debt and some senior capital. So I often think of blended finance as like transactions where you have all of those components or some of those components mixed in together. I think guarantees are a really important component.
Great, thanks. Another question is about the technicalities. For the guarantor, how does the accounting work? I know this was mentioned a bit in your structure of some of the examples, Tracy, but generally, how does the accounting work? Contingent liability or investment?
Yeah, so I'm not an accountant. The way that we manage it at Casey is for our social investment or our endowment performance, it becomes a contingent liability, which means that it's noted on the balance sheet, but it doesn't actually reduce the amount of capital that we're able to allocate through our social investments portfolio. So we have a 4% allocation. The guarantees don't actually count towards that 4%, unless they're called. And then, I actually just had a conversation with our accounting team. So on the really detailed, weedy side of accounting, my understanding is that when there's some account they have to mark the guarantees at fair value, and they usually use whatever income we earn on the guarantee as the indicator of fair value. So if there's a guarantee fee that's paid annually, then that would be the fair value.
Yep, and I just want to make, this is Hannah, I just want to make a plug for a section of the report on page 37 that has some of these accounting practices for guarantors laid out. There probably is a little bit of variation across different foundations and how they've decided to do it, but certainly what Tracy has said resonates with what we've heard and what's in that box. And I think the overall takeaway is kind of, as you said, Tracy, just making sure that it's clear how they're being valued and how the risk is being managed, and noting that on your financials for auditors to see.
Great, thank you. There's a question that's phrased kind of around some of the barriers that may come up, and I'll just read it verbatim. To play devil's advocate for a moment and to help better satisfy questions to skeptics of guarantees, how do we ensure there's no moral hazard issue? If the borrowing organization is off the hook regardless of the financial outcome, how can we effectively incentivize orgs to repay?
I'm not sure that I fully understood the comment. I mean, I would say that, you know, the borrower is absolutely on the hook. I mean, I think, you know, there is, I mean, so in the Center for Family Representation example, they are the borrower from the bank. So they have that relationship that they want to maintain. The guarantee is a relationship between the foundation and the bank in terms of documentation. So the borrower actually has a lot of reputational risk if there is a failure to pay and then there's a call on the guarantee. So so making sure that you know, there is that understanding that really, you know, the guarantee is there to help induce the additional capital to come in, but there's still an expectation around performance on the, you know, on the part of the borrower.
Yeah, and a lot of times the guarantor will structure in some conditions that, you know, the lender actually has to try to their utmost to recoup, you know, try through other means to recoup losses before calling on the guarantee. So whether that's, you know, going for collateral or other things, those provisions are often in there as well.
Great, thank you. Can you speak to any examples that you may know of U.S. community foundations using guarantees with local nonprofits? I know you lifted up a couple in regard to the examples you shared, but can you maybe go back explicitly on how those were structured together with the nonprofits, please?
Is this a question for one of us specifically, do you think, or?
I think either of you, just, you know, how, maybe talking through specifically how, well, I guess first, have you heard of community foundations specifically using guarantees with local nonprofits?
Yeah, the maybe, Tracy, you may have also, but the one that I know of is Grand Rapids Community Foundation. I've spoken with about their use, and there are others. I think that what we saw in terms of the providers of guarantees in the research is that it included lots of different kinds of foundations, from the large private ones to the smaller community foundations and others. Certainly, some of these structuring options will depend on what the balance sheet of the foundation looks like. So banks are going to be more inclined to accept an unfunded guarantee from a foundation with a very large balance sheet, since it's not, you know, that material as a percentage of their overall endowment, whereas a foundation that doesn't have a large endowment may need to fund the guarantee by, you know, having some visible set aside for it. On the other hand, some of the smaller or more community-based foundations have really good relationships that can sort of stand in for the size factor. So we've seen a number of different structures. One other thing I'll say is we've seen some cases where the foundation basically provides a grant to the nonprofit that is to be used as a guarantee in the event of any losses. And then if that's not needed, it can be, it's either a recoverable grant or it can be just, the agreement might be that it's just meant to be used by the nonprofit for certain purposes after the period of the loan. So just some different thoughts on that from what we've seen.
Great, thanks. I'm going to go ahead and, show the slide with Hannah's contact information as well. And there's a couple more questions I'm going to jump into, but just pause to let you know at the end of the call you'll receive a thank you email for joining, and the link for the report will also be in there. So some of the resources will come to you directly. Others will be sure to follow up, and thank you for making your contact information available, Hannah. To go back to more of the questions that have come in, someone asked explain that they can see how guarantees work for the real property projects. And the question is, have you used them for social enterprise organizations beyond the bridge loan example you gave for someone waiting for government grants? Are there any other examples for social enterprise organizations that come to mind for you guys?
So we have one, which I referred to, but not in any detail, where we provided, Casey and 2 other foundations provided a guarantee for a working capital loan that was for a startup entity that is, so that was another example where we had provided that. And in this case, we're actually, I should say, we're in a, it was hard fought. There were a number of circumstances that happened, but they've ultimately made the decision to wind down. So we ended up paying out on that guarantee, and we are unlikely to recover much given the limited assets that they have. So that's the other really good social enterprise example that I have. Hannah, I'm sure you've heard of others.
Yeah, I'm trying to think. I mean, so the database, obviously, like some of that data was gathered under a condition of confidentiality, so I don't want to speak out of turn too much, but as a general point, certainly we've seen other examples where a social enterprise perhaps was early stage or trying out a new model, and a guarantee helped for them to raise some funding to be able to grow and develop. So yeah, that's been done.
Yeah, and I've also, I mean, I think that guarantees for social enterprises can be used in a number of different ways. I mean, there was also, we didn't participate in this, but I know another foundation that provided a lease guarantee. So, Hannah, you gave that example earlier about needing a guarantee for an apartment, which is certainly, I think, something that a lot of us can relate to, certainly if, we were right out of college, but it's the same for organizations as well. And that that ability to have a guarantee on the lease for a new facility was important for that enterprise.
Thanks. Relating back to the question you guys shared about, or excuse me, the answers you guys shared to the question about the challenges or kind of moral issue that came up. The question came from someone who had experience in the microfinance world where there was significant default rates, and the board therefore had been considering using guarantees to prevent credit damages to borrowers, but decided against it because of concerns about the incentive structure. I'm curious if you guys, if that context provides more specificity to help for kind of the naysayers or folks who you've seen steer away from this, or examples you've seen help overcome some of the challenges that are presented in that. So that's the specific question kind of following up from that.
I don't know if this directly responds to it, but it's another structure that I think is interesting in terms of how you can set up those incentives. you know, one thing we've seen in a few examples is a reducing level of coverage over time if certain kind of markers of success are met. And I think really there's incentives, the borrowers are incentivized to, I think in most cases, you know, they're not trying to default, right? Like they want to be successful in this, build their track record, be able to get financing in the future. And so, you know, and sometimes we hear about it actually in terms of a moral hazard for the lender or the investor, in the sense that if you 100% back them up, then they may not be doing the level of underwriting or understanding the risk that they would do in an investment where they didn't have that support, and therefore they're not really, you know, gaining any meaningful experience with this new sector, business model, or type of loan. And, you know, they may just not be on the same page. I think the point that Tracy made about open communication is really critical. So to make sure that their incentives are also in the right direction, having a level of coverage that maybe starts out at less than 100% and then also declines over time as certain milestones of success are met is something that some folks have used to set those incentives.
Great, thank you. Well, I appreciate the audience. Thank you so much for your time and for your really thoughtful and detailed questions. I'm excited to see people digging in deeply on the content here and obviously getting into the specifics. So I hope that means that this has both been a helpful conversation in providing more information for you to move your projects forward on this topic. And that if you have follow-up questions that you can obviously reach out to Hannah. She's provided her information, and I'm happy to help connect you as well to folks if you want to email me, biz@epip.org as well. But that is the questions I had prepared. In case you guys didn't have questions, were far bypassed by the specificity and sophistication of your questions. So I appreciate you superseding my planning ahead, and I'm grateful and respect all of the work you guys are clearly all doing on this topic. Thank you so much to Hannah and to Tracy for your time, for sharing your expertise, for coming together with EPIP to help our community dig in on this topic. It's exciting to see it moving forward quickly, and I hope we can continue to partner and lift up some of the great work you guys are doing. So if you guys have any closing words, I'd love to pass the mic your way.
No, thank you so much. This is Hannah. Thank you again for the opportunity to present. Thanks everyone for joining, and I do encourage you to download that report. All of our research is free and publicly available on our website at that link that's up there. And I think the link that'll also go out. So please dig in, send me questions. Happy to connect after this. Thank you.
Yeah, and I'll just say thank you as well, and echo that I think the report that the GIM put together is really well done and very informative and is a great resource. So thanks.
Wonderful. I hope everyone has a great rest of your day and that we see you again here. Take care. Bye-bye.
Bye.